a lot of them are making money. But he spoke about, single-digit PEs, the valuations, etc., talking about E of the P. That's the earnings season. That was upon us, Nigel. You did an analysis of the report card. How did that look?
So let me go across to the big wall, actually, and give you an analysis in terms of how did the earnings scorecard look like for the past quarter itself. So just taking stock out there, the broad consensus is no worries with regard to the Nifty EPS and the earnings out there. Maybe some concerns coming on in terms of the broader market. So the consensus basically has been maintained. If you're looking at the forward earnings, well, it's revised by close to under % for Motilal Oswal. And Novoma, they have put in some numbers out there. They say that, in fact, the growth that they're looking at is 15 to 16% for this year. That's this fiscal. It compares with around 10% in the last fiscal. And they're saying that, in the first half of the year, we have grown by more than 20%. So that means the asking run rate for the second half of the year is only 8 to 10%. So no worries with regard to FY24. The question is, will the 15% forecast for FY25 be a little bit too optimistic? So that needs to be answered because they're highlighting a couple of headwinds that could emerge. Maybe the best of margins are going behind us and consumption is slowing down a little bit. Now, the broad consensus, though, with regard to the earnings on the whole, Jefferies, they say that they've cut earnings estimates for 51% of the 150 companies. And that's the highest number in terms of earnings cuts that they've seen in the last 7 quarters or so. Motilal Oswal, they say they're tracking on 240 companies. And in terms of beats and misses, well, there were more number of stocks that beat their estimates. Misses were far less, and in line was close to around 80 companies odd. The problem is, from the broader markets, the BSE 500 companies, will there be an earnings miss from here on? Because the top line grew by only around 5%, but the PAT surged by around 25%. If you look at PAT margins, the expansion was to the tune of close to around 400 basis points to around 13%. And this was very, very strong, so that's a question mark whether or not this can sustain out there. Input costs were lower, and that's one of the reasons why profitability looked good. And with lower input cost, you had operating cash flows as well that looked quite good. Because the working capital requirements did fall down. They're highlighting, though, that, the cash flows have improved this time around, so no worries in terms of the capex so far. But the problem is, you have the small and the mid-cap companies where their earnings are a little bit more cyclical in comparison to the large-cap names, and that could put some pressure out there. So they're saying that it's a good showing, but is it sustainable? The superior margins, they drove earnings to outperform in the past quarter in comparison to the large caps. But there is a bit of a question mark in terms of the earnings estimates going ahead. And finally, they're saying that, the wage bill as well, the growth out there was only around 11%. And at some point of time, this low growth in the wage growth, that's what could hurt consumption as well. With the slowdown that we've seen in the export market, there are signs of the slowdown as well. So will this lower wage growth hurt? So put it all together, the Nifty EPS, fairly good. No worries in this year. Will there be a question mark for the following year? And broader market earnings momentum, can it sustain? Well, let's get in Ajay's view on. Well, thanks so much for tuning in to CNBC-TV18. Make sure you follow us and stay updated on all our social media platforms.